If your management accounting system is badly designed, managers can be making confident decisions on weak or even misleading information. In this video, we will unpack what a management accounting system is, how it should be designed, and the levels of information it must provide for planning, control, and decision-making. In management accounting, a management accounting system is the whole information system around management accounts. It is the people with accounting skills, the technology and records they use, the cost accounting system underneath, the analytical techniques and reports, and the managers who read and act on those reports. So it is not just software or a few spreadsheets. Think of it like an ecosystem where data flows in, gets processed by accounting methods and tools, turns into reports, and then influences behavior through the managers who rely on those reports. The core purpose of this system is to generate information that managers need to manage resources and create value for customers and shareholders. That means it must support planning, where you set direction, control, where you compare actual to plan, and decision-making, where you choose between options. You can think of the management accounting system as the organization's information engine room. If it produces the right information at the right time, managers can steer resources toward value creation. If it produces the wrong information, plans and controls will be off track. A common weakness in many management accounting systems is an over-reliance on what is easy to measure in dollars and in the short term. They focus on financial figures and recent profit while ignoring non-financial aspects like quality, flexibility, customer satisfaction, and employee capability. This is like judging a restaurant only by last week's cash takings, without asking whether customers were happy, whether service was quick, or whether staff can handle a new menu. The financial numbers might look fine while the underlying drivers of future performance are getting worse. There are other key risks when using management accounting systems. One is a narrow internal focus that ignores customers, competitors, and suppliers. Another is poor goal alignment, where measures encourage managers to optimize their own department rather than the organization as a whole. A further risk is putting too much weight on historical cost information instead of relevant, future-oriented information for decisions. Past costs have their place, but for many decisions, what matters is how different choices will affect future costs and benefits. Even if a system started well, it can become outdated if performance measures and reporting methods are not updated as circumstances change. In that case, managers may still get neat reports, but those reports no longer match the current strategy or operations. Designing a management accounting system properly starts with clarifying information and timing needs. You ask what decisions managers need support for, what level of detail and accuracy they require, and how quickly or how often they need information. For example, strategic decisions may only need high-level summaries each quarter, while operational supervisors may need detailed figures daily. Getting this clear at the design stage ensures the system is built around real decision needs, not just what the technology can easily produce. A well-designed system then specifies where data will come from, both internal and external, how data will be collected and stored, and which processing methods and techniques will convert raw data into useful information. It also defines how that information should trigger specific management responses and decisions. So you are not just listing reports, you are mapping the whole chain from data sources through cost accounting and analytical techniques to the moments where managers are expected to act on what they see. Performance measurement within a management accounting system has to reflect the nature of the organization. In a service business, you might measure flexibility, excellence, innovation, financial results, resource use, and competitiveness, because those dimensions capture how well the service is being delivered. In not-for-profit and public sector contexts, performance measures often concentrate on economy, efficiency, and effectiveness. Together, these allow you to assess whether the organization is providing value for money given the resources entrusted to it. An effective management accounting system also delivers information at 3 distinct levels. Strategic information, often external and non-financial as well as internal, supports long-term direction. Management control information, usually quantitative and often monetary, supports budgeting, monitoring, and decisions across the organization. Then at the base is detailed operational information, which is transaction-level data in units, hours, and quantities. This supports day-to-day implementation of plans such as scheduling staff, ordering materials, and tracking actual activity. Let us walk through a worked example. Imagine a service organization that wants to improve performance. In services, production and consumption happen at the same time, and there are no finished goods inventories to track. So the management accounting system needs to reflect that reality. The management accountant designs performance measures that go beyond financial results. They include indicators for flexibility, such as how quickly services can be adjusted to customer needs, excellence, meaning the quality of service delivered, and innovation, such as the introduction of new or improved services. They also track financial performance like revenue or cost trends, resource utilization, meaning how effectively staff time and other resources are used, and competitiveness, which shows how the organization compares to rivals. These measures are built into regular reports produced by the system. Managers can then monitor each dimension, see where customer needs are being met or missed, and take targeted action to improve service performance. The key is that the management accounting system has been designed around the real drivers of performance in that service setting. To recap, a good management accounting system is a carefully designed information system that supports planning, control, and decisions, avoids common risks like narrow financial focus and outdated measures, and delivers strategic, management control, and operational information in a way that fits the organization. As you keep studying, ask yourself whether each technique you learn would actually improve the information managers receive. If you found this helpful, subscribe and keep building your management accounting toolkit one concept at a time.